the administrators of the room had a problem getting the room started today, so there's still a lot of people trying to get into the room. So I'll end up saying some things now and repeating them later. The obvious thing today is that it's an FOMC day, and the day will be a normal day like any other day up until the FOMC report at 11 o'clock. Everybody should exit their day trades ahead of the report and then wait 10 minutes before trading again. And that's because most of the time, right after the FOMC report comes out, in the first 3-5 minutes or so, the market makes a sharp move in both directions, up and down or down and up. And it takes about 10 minutes for the market to decide on its direction. And during an FOMC day, you should be open to anything. Here's the FOMC report. We had a failed bull breakout and then a bear trend. Here we had a bull trend with a deep pullback. So you can get a bear trend after the report, a bull trend. You can get a bull trend that reverses into a bear trend that reverses into a bull trend. You can get a trend that just keeps reversing for the remainder of the day. And rarely you'll get a reaction that looks like no reaction at all. You know, when you look at this chart, you would never suspect that it was an FOMC day. But the important point, 2 points are: wait for 10 minutes before placing your first trade and be open to anything, you know, a bull trend, bear trend, a reversal, or a trading range. As you know, I think we're probably going to be headed up soon, possibly today. I know we got 5 bear bars, but that's a reason to think we're heading up. How often do we get 5 consecutive bear bars? We had 4 here, we had 4 here. 5 is pretty unusual. A few years ago, we had 10, which was extremely unusual. 2018, we had 10 consecutive bear bars, extremely unusual. But even in the biggest sell-offs, you know, we've had many, it's hard to get more than 4 or 5 bear bars. You know, here are 4 and then sideways. We had 6 here and then a pretty good bounce. And here we never had 3 again. Most we had was 2 consecutive bear bars. Couple bear bars. And therefore, you know, we're probably going to bounce today or tomorrow. Also, we are really oversold. Monthly chart, I bring this up. I've said it several times. We were above the 20-month moving average for about 20 bars, and we're down to it. And normally, traders will be willing to buy there. They've been willing to pay above it for a long time. And every time we get down to it over the past decade, they bought. Sometimes it went far below and they bought, but they bought. So that's one reason to think that we're not going a lot lower. And then another is strong bull trends do not become bear trends without first becoming trading ranges. So you have to have some kind of a trading range, some kind of a double top or a wedge top, or need some kind of transition from a bull trend to a bear trend. About 30% of the time, a strong bull trend can just immediately reverse into a bear trend without first going into a trading range. But we're probably going to get a bounce sometime soon. But the big debate is whether we'll get down to the high right before the pandemic, the pre-pandemic high, which is around 3,300. I've been saying since January that I thought the bottom would be below 3,900 because I thought we would fill this gap from last year on the monthly chart, and probably above 3,700. And do I still think that's true? You know, we may come down here. So I think the worst case is maybe a test of the pre-pandemic high. So worst case, 30% chance we'll get down to 3,300, 70% chance we will not. This is a pretty good sell-off. So it's unlikely that we're going to reverse straight up. It's more likely we began a trading range back here last year in September. So we went down more than what the bulls wanted, and therefore they'll be less willing to buy for a trend up, more willing to buy for a trade up, expecting a trading range. First bar of the day, we broke above yesterday's high. Yesterday's a bear bar in the daily chart. That's a bad buy signal bar. And after 5 bear bars, you'd expect not a lot of buyers buying with a stop above yesterday's high. It's also a neutral bar. Yesterday was a trading range day. It was a bear channel. We kept making new lows, new lows, new lows, and we had a lower high. We had a nominal higher high, but it became a double top, and then another lower high. So lower highs, lower lows, bear channel. But it was mostly a trading range that broke to the downside. The bear breakout failed, and we reversed up. And that's what usually happens when you have a trading range that lasts 4 or 5 hours. If you get a breakout in either direction, it's more than a 50% chance the breakout will fail. It's more like 60% chance the breakout will fail. Now, not a good buy above 1, not a good sell below 1. Can you sell below 2 if it's a bear bar closing on its low and below 1? That will start to attract sellers, but a lot of traders like to see consecutive trend bars, 2 bull bars. It's possible bar 2 will be a bull bar, but will traders buy above 2? If it becomes a very big bull bar closing near its high, I think you'll get bulls willing to buy up there. Globex high, we're right at the Globex high, 275. Yeah, we're 1 tick below the Globex high. We're a tick or 2 above yesterday's high, and 1 tick below the Globex high. 90% chance we're either going above the Globex high or below the Globex low. And maybe 10% chance we do both. So 10% of the time, maybe a little bit more, we'll break out of the Globex top and bottom. For the bulls, this is a trend up. We have a trend here. The gap up is a bull trend. And therefore, 1 is a pause in the bull trend. So theoretically, it's a high 1 buy signal above 1 or above 2. But as I said, that doji at the top of 1, at the top of yesterday's trading range, is a neutral thing. And if you're going to be paying far above the average price, you want bars that look far above average. And right now it looks like 2 is going to be fairly average, even if it goes outside up. Unless it becomes an extremely big bull bar closing on its high, I think most bulls will wait. We have a big tail on the top of 1, on the bottom of 1, big tail on the bottom of 2. And tails represent reversals. It means it went up, it went down, it went down, it went up. And that means indecision. And whenever the market is undecided, it's usually a bad thing to buy high and sell low. In general, whenever things are unclear, like yesterday, it's better to buy low, sell high, and take quick profits. I want to say one other thing about yesterday. It was basically a trading range, you could say from bar 11 to over here, and then we had the bear breakout. And bulls will look to buy a first reversal up, buy above a bull bar closing above its midpoint. And 71 did not close above its midpoint. So some bulls bought in a panic during 72. Some waited for 72 to close and then bought above 72. But the problem with that is obvious, right? The risk is big. But very often you'll get a small bull bar down here, so the risk will be small. All right, so we have a pair of dojis. So the bulls were in a bull trend since 70, and it's a high 1 bull flag, a pullback, and a bull trend. But it's a bear bar. it's a doji bar. We had 2 doji bars, and we're at resistance to Globex high and yesterday's high. So I think it's better to not buy above 2 and wait to see if we break strongly to the upside on 3 or 4. Breaking above the Globex high. On the open, when you're looking for a bull trend from the open, I like to see consecutive bull bars with at least one being big and closing near its high. And therefore, I'm probably not going to buy above 3. I'll wait to see if 4 is also a bull bar. The bears are hoping that the breakout above yesterday's high reverses down a second time. Remember, 1 broke above yesterday's high and reversed down on 2. And we're breaking above yesterday's high a second time here. And the bears will try to get a second reversal down, maybe on 4. Yesterday we had 2 reversals down on the open, bar 2 and bar 7. Now, if I'm bullish over the next week, isn't it worth just going ahead and buying? We're talking 2 different things. I'm bullish over the next week, and therefore I'm looking for trades to hold for a day or 2 or 3 in my overnight account. But on the 5-minute chart, I'm not yet willing to buy up here on the day trading account. Big gap up. 4 things usually happen. The bulls do not want to pay too far above the average price. The moving average is one measure of what is average. And therefore, they'll try to buy closer to the moving average or at the moving average. And if they get that opportunity, there's usually a double bottom or a wedge bottom. So the bulls are looking for a double bottom or a wedge bottom near the moving average, hoping for a swing up. And the bears want to sell, and usually they'll get a double top or a wedge top, and they can then sell. And if you do have some kind of a trading range open, 80% of the time you do. But if you do, and then you get a trend, the trend usually does not last all day. It could last several hours. But if you had an early trading range, it reduces the chances of a big trend for the rest of the day. The bulls are hoping a big gap up. You got several possibilities. This is the open of the day. It could be a bear trend day. It could be a bear trend day that reverses into a bull trend day. And it could be a bear trend day that converts into a trading range. It could be a bull trend from the open, even if there were some early selling. A bull trend that reverses down, a bull trend that becomes a trading range. And obviously, it could simply remain a trading range day like yesterday. So right now, we do not have enough information, I think, to formulate an opinion. Now, I have this blue line just above open of the week. Why is that? Because on the weekly chart, we have a big gap down. Every week, I always put some kind of a marker on the open of the week, because at the end of the week, if the week is a bear bar, it increases the chances of lower prices the following week. If the week is a bull bar, it increases the chances of higher prices on the following week. So the market pays a lot of attention to the open of the week. And right now, we have a reversal. It's only a doji bar, but as I said, I think the market is very oversold, and I think we're probably going to bounce starting sometime in the next week or so, and possibly today. The May 20th low on the daily chart, that was an attempt at a bottom. At the time, I said there was a problem. It was not a good buy signal bar. We did not have a good buy signal bar here or here. And I said it increased the chances the reversal up would be minor. And you can see we broke below it. The bulls have the same problem here. A bear bar is not a strong buy signal bar, and it increases the chances that this reversal up will be minor as well. But if we start to get a series of bull bars, it doesn't matter if you have a bear bar. like this, a bear bar, but then a series of bull bars, you can still get a pretty good reversal. Last week's low, remember we gapped down this week, so the bulls would like to get back above last week's low. Daily chart, you can call it a second attempt at the bottom. We tried to bottom here, we failed, we broke to the downside, and now we're trying to get an expanding triangle. 1, 2, 3. You can call it a lower low double bottom. We'll probably need a micro double bottom in addition to a lower low double bottom. So I doubt we're going to go straight up, but we might. We're really oversold. Weekly chart, bulls trying to get a credible buy signal bar. They had a good one here, but it was the first reversal down after a climactic rally, so you'd expect a second reversal, a second leg down. And monthly chart, it's unlikely we're going to fall very far. We're pulling back to the moving average, and every time we've done that over the past 10 years, the bulls bought. Sometimes we went sideways for 6 months, and then they bought, but they bought. Here, sideways for a couple of years, they bought, and they bought again. Now, I said the minimum the bulls want to start buying closes, buying the market, buying with the stop above the bull bar, is consecutive bull bars, 1 being big and closing near its high. 3 is big, and it's closing relatively near its high. So traders might be willing to buy above 3, especially if 3 closes near its high. Well, as I said, we reversed down from above yesterday's high, below bar 1, and the market might try to get a second reversal down. For the bears to short, they'll want as good a sell signal bar as they can get. 1 was not a good sell signal bar. So they'll want a bar that looks like yesterday, 7. If they get that, bears will sell. Another reason I mentioned this last week, the market tends to rally at the end of June into the 4th of July. Excuse me. A couple of reasons for it. It's end of the quarter. June is the end of the second quarter, and a lot of institutions want to have on the books all the good stocks. So any stock that behaved fairly well or relatively well, a lot of the institutions will buy those stocks. So you tend to get whatever cash they have, they'll be putting it in the market, trying to make their portfolio look better for the quarterly reports. And then you also have a little bit of summer euphoria, euphoria going into the summer, going into the holiday. And I think both those factors increase the chance of a rally at the end of the month. Decades ago, I did a lot of calendar testing, looking for seasonal patterns. And, I'd check, June 20th, June 21st, June 20th. I'd find which day was the most likely one to lead to a rally. And it was, I think, June 26th through July 5th or so was the best window. And that implies that the market could be sideways to down ahead of that. If that's going to be seasonally bullish, it might be down, sideways to down going into it. I never place trades based on calendar tendencies because the math is just not good enough. There are many other reasons to take trades that have better math. So right now, this is a buy the close rally. We have consecutive bull bars, 1 being big, closing near its high, and bar 4 is a bull bar closing near its high and above the high of 3. So there's a gap there. 3 closed above the high of 1 and 2. There's a gap there. And gaps are signs of aggressive bulls. They're willing to buy into the close of the bar above the high of a prior bar. That means more aggressive bulls. I don't like to see shrinking bodies, but right now this is buying the close. Do you buy it? If you do buy it, I would get out maybe 5 points below the low of any bar, including a bull bar. And I'd get out a tick below a bear bar closing near a slow. I'm concerned that the bars are not especially big compared to yesterday's bars. So yes, 3 is big, but it's not particularly big. And it has a prominent tail. And 1 and 2 are doji bars. So, and yesterday was a trading range day. So there's a big magnet here in the middle of yesterday. So, and then also, as I said, the market very often will make 2 attempts to do something before giving up. So we tried to break above the high of yesterday, bar 1, it failed, 2 went below 1, and we're trying to break above it again. And yesterday we had 2 reversals down, and we got a trend. The bears might try to get a second reversal here. To sell below 5, the minimum the bears want is a bear body. Most bears will not sell below a bear doji unless there's something else going on, like yesterday, a double top, higher high double top, and a climactic bar and a parabolic wedge. So the bears would like a decent sized bear bar, and they'd like it to close on or near its low. And if they don't get that, they'll wait to see if we get a second bear bar, a third bear bar, and then they'll start to become more aggressive. And the bulls don't want that. So if 5 is a bear bar, what are the bulls going to do? They're going to buy, because they don't want 6 to go below 5. So important bar here. Is this simply a failed breakout above the Globex high and a second reversal down from above yesterday's high? Or is this the start of a big bull trend day? 2 dojis on the open, small bar 4, reversal 5. This is not behaving the way strong bull trend days typically behave. So I am not, I'm flat. Now, will I short below 5? I'm probably not going to. I'll probably wait to see what 6 looks like. This looks like a trading range type of open. On 1, we went up and down. On 2, we went up and down. Up on 3 and down on 5. Okay, so bulls will buy the close of 5, and they'll even buy a tick or 2 below 5. But I think it's good to get out either a tick or 2 or 3 below 5. If it keeps going up in a small pullback bull trend, you can always buy again above the next bull bar, maybe 6. And bears, can they sell below 5? They can do it for a scalp and take a chance this will be the high of the day, or at least the high of the next couple of hours. When you look at this, though, don't you sense some confusion and uncertainty? And if you don't, you should, right? You know, we have reversals on 1, reversals on 2, and then up on 4, down on 5. So it's not yet clearly bullish. Sometimes you'll get a bull trend from the open, and it just keeps growing in a small pullback bull trend. We have a small pullback on 2, it went a little bit below 1. 5, a small pullback, a little bit below 4. I always pay attention to gaps, especially in the first couple of hours. And there's still a gap. The 5 low is above the 1 high. If we get a second gap, let's say 8, 8 or 9, closing far above 5, that would increase the chances that this small pullback bull trend is going to last. Small pullback bull trends a lot of times just look weak. A lot of small bars, yet the pullbacks are small. Okay, it doesn't look all that strong. Here, pullback 5 bars. Sometimes you get really small pullbacks like this. I'm trying to go to the next slide. Like this, just a little bit. The bars do not look all that bullish. We got a bunch of dojis here. Bear bar here, and then we got a gap this low, that high. and plus it's 4 bull bars, 3 of them closing on their highs. When I see that, I conclude that the odds of this lasting a long time will go up. And then you look at the low of this bar and look to the left, a little bit of overlap, but the bodies don't overlap. And the next bar is a bull bar closing near its high. So now we've had 2 or 3 gaps. A gap here, it closed. Right? I pay attention. Here the gap stayed open. Here we have a gap between the bodies. So at some point in here, I'm thinking that this could last all day. But I like to see at least a couple gaps. And if you get that couple gaps, it becomes significantly more bullish. Look at this. We're not getting a lot of big bull bars closing near their highs. We're getting a lot of small bodies and tails, but all the pullbacks are small. A bear bar closing near its low, they bought it. They bought the close. Here, a low 2, low 1, low 2, they bought it. And on these trades, experienced traders will buy for any reason, buy the market, buy at the low of the prior bar. Every time they see a bear bar, they buy the close of the bear bar, right? But most traders, the simplest thing to do is wait for some kind of a pullback, like a bear bar, and then wait for a bull bar closing near its high, and then buy on a stop above the bull bar. 6 so far, inside bar. Bulls, remember, they're trying to create a good buy signal bar on the weekly chart. They want this week to close above the open of the week. They want a bull body. They want a bull reversal bar on the weekly chart. And not only that, but they want a big bull body closing near its high. Now, I've been giving the bull case. What happens if we don't do what I said? What happens if we're not getting gaps and bull bars closing near their highs in a small pullback bull trend? It could still be a bull trend. It could be a bull channel, but it could also be a reversal. Yesterday's range is not especially big. That increases the chances of an outside down day. You go above yesterday's high, reverse down, and then below yesterday's low. That could happen after the FOMC report, but right now there's just no energy. Sideways for a couple bars here, sideways for 4 bars here, and therefore at the moment, I do not think we'll get below yesterday's low ahead of the FOMC report. And right now, we're probably not going below it regardless of what the FOMC report is. For the bulls, we have an IOI, an inside bar after an outside bar, but a tail and a bear bar. The bulls are trying to get above the open of the week. I think we're going to go closer to the open of the week. So I think we're probably going to go at least a little bit higher. We may break a little bit above it. It's common for the market to get drawn up to a resistance level, break a little bit above it, and then reverse. Bar 1, we went a little bit above yesterday's high and reversed. So we may get a parabolic wedge here, 3 tops, 1, 5, and then who knows, 9 or 10. If it goes a little bit above the open of the week and reverses. You can see the market has a cluster of resistance. I think we're going up to the open of the week and probably at least a tick above. And not far above that is that May 20th low and the 60-minute moving average. And that pink line is the low from a couple of days ago, that big gap down. Bears, parabolic wedge, 1, 5, 7, but 7's a bull bar, so not a good sell. Bulls, I'd get out below a bear bar closing near its low, 5. This is a small pullback bull trend at the moment, but it does not yet have a high probability of lasting all day. Traders are still deciding, are we going to reverse in this resistance zone, or are we going to break strongly above it? So not yet strong buying. It's still on the buy above 3 or 4. But here we are 4 bars later, and the bulls had very little profit. So not a lot of bulls buying up here. How do I know not a lot of bulls buying up here? We're not going up. We've been sideways here for 5 bars. If there were a lot of bulls buying, we would continue up. So it's not yet, there's not yet a consensus that 2 will remain the low of the day and that this small pullback bull trend will last. The bulls need, as I said, usually a couple strong breakouts. 3 is good, but they'll need another, at least one more breakout. A big bull bar closing near its high and closing above something important, like above the 5 high. For the bears, we reversed down below 1, failed. Reversed down below 4, failed. And they're trying to get a third reversal down for a wedge. But I think they will need a big bear bar closing near its low for traders to sell below 8 or 9. So they'll need something like 5. You know, the bar doesn't quite have to be as strong as 5, but they'll need something that looks like 5 to get many sellers. Right now, we should go at least a little higher, up to the open of the week or within a tick of it. I think we'll probably go above the open of the week because we have 2 other magnets slightly above that. I want to say something about a very common occurrence, and I think most traders don't understand it. The market has been going down since January, half a year. And if you look at television or read things on the internet, it's easy to find people who say we're going down more, that we're going to end up in a recession. And I think we're probably going to end up in a recession. We're very close to a recession. But the part about going down more, that's the point I want to make. When the market is going down, the people on television put experts on who say the market is going down. They do not put experts on who say the market's going up. Okay? You know, the audience sees the market going down and they want validation of their opinions. You know, the stupid world in which we live, everybody only pays attention to people who agree with them. Anyway, this is a wedge, a doji, and a small pullback bull trend. So not a very good sell below 8, get out of longs. You know, maybe a few points below 8, certainly below 5. And for the bears, I would rather wait for another bear bar before getting short. Back to my point about television and news. When the market's going down, the bears are always on TV saying, yeah, I've been saying forever that it's going down. And, you know, I'm right, I'm smart. You listen to me. So all you see on TV is the bearish case. And there's always a bullish case. And it should always trouble you whenever you only hear one side. I'm always talking probabilities because 95% of the time it's as likely to go up as it is to go down. You know, but on television, that's not how TV works. When it's going down, they only put the bears on. So it's 100% that it's going down more. But that's not true. There are a whole bunch of institutions who are not on television who are buying. They're betting that the market has gone down enough, or maybe it'll go down more and they'll buy more. You're not seeing any of those people, but they're out there, and they're about half of the trading world. So that's a big problem with television and news services. When the market's going up, you only see bulls, even though there are a whole bunch of institutions selling. When it's going down, you'll only see bears. So, you know, when you're bearish, never be as bearish as TV wants you to be. And when you're bullish, never be as bullish as TV wants you to be. Always be aware that there are really smart people with lots of money, lots of institutions who are doing the exact opposite of what TV is telling you is happening. We're in a buy zone that I talked about at the start of the year. Back here in January, I said I thought the market would fall to 3,700 to 3,900, and we're in that zone. This is a second attempt at a bottom on the daily chart. We tried to bottom here, it failed, and if we stop going down and start to get bull bars here, possibly a little bit lower, a second attempt at a bottom would have a higher probability. One other thing I want to say about the daily chart, you can see here we have a wedge, 1, 2, 3, and nobody sold it. Traders bought the 8 low. Remember I said I thought we would get to within a tick of the open of the week. 8 is not within a tick of the open of the week. In other words, I think we're going higher. I don't know how much higher. We have other resistance here, and that means magnet, so we may go a little bit higher. And this is a small pullback bull trend, and it could last all day. If it's going to last all day, we need to see more bars that look like 3. We need more big bull bars, more consecutive bull bars, 3, 4. And for the bears to get a reversal, they need more bars that look like 5. Right now, the market is still deciding. Is this simply a test of resistance, and then we're going to reverse, or are we going to keep going up through the resistance and continue up all day? I want to go back to the daily chart here. I want to make a point. Here's the daily chart. And we've been sideways for a year. Where to start? I don't know, you pick a price, I don't know. Okay, but, we're barred a year. Here's last April. We went up, but it turned out this was a bull leg in a trading range, bear leg, bull leg, bear leg. We've been sideways for about a year, and we had a pretty good bottom attempt here. Let me put this right there. And we broke strongly below it. We pulled back above it. So this rally, even though it went above this breakout point, you got to be thinking, maybe we're going to get a measured move down based upon this trading range. Head and shoulders top, left shoulder, head, right shoulder, and the head subdivided into a head and shoulders top, left shoulder, head, and right shoulder. But maybe this is just a bull trap pulling back above the breakout point, and we're still going down for a measured move. And I think it's important, and that's why I'm doing this. Okay. Well, I'm not doing it well. Let me space this out more so I can be more accurate. So if this breakout is going to lead to a measured move down is here, 3,400, and it's pretty close to the pre-pandemic high, the February 2020 high, around 3,300, which is the magnet. So it's possible that we have a trading range, a head and shoulders top, a breakout, a pullback, and we're going to continue down to 3,400 or the pre-pandemic high. As I said, 30% chance we get all the way there. We might go a little bit lower, but I'm not confident that we're going a lot lower. I know you got people on TV and on the internet saying we're going down 40%. But I think the chance of that, I think there's a 30% chance we go down 40%, down to here or below. A lot of stocks are already below that. JP Morgan, here's the pre-pandemic high, and we're far below it. All right, so the bears have another bear bar closing near its low. Reasonable to get out of longs below 9, a possible high of the day. But I still think we're going to go higher. So I did not sell below 9. What happens if we get 2 bear bars? Then I'll become more interested in shorting. But I'm not confident that we got close enough to the open of the week for traders to conclude that we fully tested it, so we may have to go up a little bit more. It's okay to be short, holding for a swing. This is a possible high of the day. Bulls will try to get a bull bar on 10 or 11. It's possible that instead of this being a wedge 1, 2, and 3, the count may have started over again with this breakout. So this could be 1, 2, and then one more new high for 3. But would I hold longs here? I would not. If we get a bull bar 10 or 11, reasonable to buy again. It's still in the short below 8 or 9. It's still a swing short, not a scalp. And the bulls are hoping that we maybe get a double bottom 5 and then get above the open of the week. As I said, I'm not confident 8 adequately tested the open of the week, so we still might have to go closer to the open of the week. Can you be long here? I would not. I'd either be short or flat and wait to see if we get a bull bar closing near its high, 11 or 12, and then buy again. On these low probability trades, it's low probability bulls and bears, but I would only be short right now. One thing that I often do is trade small, and if it continues down, I add to my short position. But because of a cluster of 3 magnets above, and we did not get to within a tick or so of even the first magnet open of the week, I think this is a minor reversal and that we're going to try to get higher. And that's why I did not short. Normally, I like wedge rallies on the open to sell, but I do not believe we've adequately tested 8. I will change my mind if we start to get big bear bars, 11 and 12. But right now, I think most traders are not convinced that we got close enough to it. The admins had a problem getting the room open today, and I want to go back to what I said earlier. It's an FOMC day, and you trade the day like any other day, but get flat exit day trades ahead of the report. And when the report comes out at 11 o'clock, be ready for anything. You sometimes get a bear trend. You sometimes get a bull trend. You sometimes get a bull trend that reverses and becomes a bear trend. You sometimes get a bear trend that reverses and becomes a bull trend. And sometimes the market just keeps reversing. And then other times it doesn't do anything at all. So be ready for anything. And the other important point is this. When the FOMC report comes out, there's usually a big move in both directions. So here we went up sharply and down sharply. So it usually takes about 10 minutes before it decides on a direction. So it's better not to trade during the first 2 bars after the report. Wait for 10 minutes after the report and then look to see if there's some kind of a setup. The bars are often big, so if you do trade, it's probably better to trade small. And by small, I mean like 20% your normal position size. If you normally trade 5 E-minis, you trade 1. If you normally trade 1 E-mini, you trade 2 micro E-minis. That's what I do. You know, I trade about a 20% position size. And then if it keeps going my way, I add to it. Bulls, double bottom bull flag 5, and magnets above several. And they're not minor magnets. These are really important magnets. So I think we're going to try to go up there. Bears, if they sold below 9, stop is above 8. And do they get out above 11 if it's a bull bar closing near its high? I would, because it's a credible buy, and we're still always in long, and we have magnets above. So if 11 has a 2-point or 3-point bull body, I get out of shorts and get long, but it does not. It's a doji bar. So now we've had 4 bars without a bull body. Actually, 11 has a small bull body. But for me, that's not a good enough buy. And I'm not short. If I were short, I'd get out probably above 8, even though there are magnets just above 8, and the market may go a little bit above 8 in reverse. I would simply sell again. So I'd get out of shorts above 8, and for the bulls, not good enough to buy. Bar 12, the final bar of the hour. So its appearance affects the appearance of the first 60-minute bar. Excuse me. 60-minute chart, the bulls are hoping that we break strongly above the 60-minute moving average. But this first bar has prominent tails above and below. It looks a lot like most of the bars yesterday. Also, we have a tight bear channel. It's the first reversal up, so it's probably a minor reversal. Not a very good looking buy bar for the bulls. It looks like yesterday. It's one of those stupid trade station things. I'm going to turn off the screen for a second and try to fix this. Every now and then, trade station gets messed up with the minimizing and maximizing of the window. And the problem is this: there's no minimize or maximize box for this chart. So I'm going to close out the workspace and reopen it. I'm reopening the workspace. And now the box reappeared, so I can then shrink the chart back down. You can see we went above 11, a high 1, and a double bottom 5. But not many traders went above. In fact, not many traders have been buying or selling since 4. Tight trading range, breakout mode. Always in long, small pull by full trend, magnets above. So I still think we're going higher. That's the end of the first hour. And right now we're on a sell below 8, a sell below 9, a buy above 11, but not a very good buy. The sell's not very good either, as I said. I'm flat. I still think we're going up. I prefer to buy both bull bars closing near their highs. Had 8 reached the open of the week, or got within a tick of it, or went a few ticks above it, and then reversed, I would have sold below 8 or 9. Because it did not, I'm left wondering, is it going to get there? And that's why we're going sideways. Too many traders believe that 8 did not fully test the resistance, so they're waiting for more evidence that this is the top. Bears trying to reverse 3. We broke to the upside 3. Bears trying to break to the downside 13. They're hoping this is the high of the day. They want to get a gap, a close below the low of the prior bar. They want to get a big gap. They want 13 to close far below 12. Reversal, reversing 3. Is it still a small pullback bull trend? Probably not. This is probably too big of a pullback. And for the bears, 13 is important. The more it closes on its low, the bigger it is, the more bears will sell. You have bears selling a little bit now as it's forming. They'll get out if we end up with a big tail on the bottom of 13. Some bears will wait to see what 14 looks like. But it's really kind of messy. There's support below at the moving average and the low of the day. So trading range type of trading, traders do not want to buy too high. The bulls have bought above 3, above 4, above 7, all lost money. And the same can happen to the bears unless we start to do things that are more consistent with a trend. Consecutive big bear bars, closing near their lows, closing below support, low of the day, moving average. Will the bears have sold below 8, below 9, scalp out 10 points, or will they sell more as it goes down? If they scalp out, increases the chances the trading range will continue. If they sell more, we'll get a big 13 closing on its low, and 14 will also be a bear bar, and possibly a big bear bar. But every bar today has a conspicuous tail, and that is not good for stop entry traders because it represents the market going in both directions, and it's happening on every bar. So there's a lack of conviction. There's no sense that the price is terribly wrong, and we have to quickly move to a fair price. Is 13 simply a test of a bad buy signal bar high, bar 2, or is it the start of a reversal down? The bigger the tail below, the more likely it's just a test of the 2 high. 2 is a bad buy signal bar. So some bears sold the 2 high, sold more 5 points higher, 10 points higher, and then they buy back their shorts now that we're at that 2 high. All right, so we've got a bear bar, but it has a decent sized bear body. But do you think a lot of traders are willing to sell the close of 13? Probably not. And we have a gap, 13 closed below 12, but just slightly below. And now 14 is already back above, it's above the 11 low, and it's at the 12 low. This is not bearish enough to attract a lot of sell to close bears. Bulls want a failed breakout, so they want 14 to be a bull bar, especially a bull bar closing near its high. And you'll get bulls buying again, hoping to get up to the magnets above. You can tell I'm not particularly bullish, I'm not particularly bearish. I think the bears have not yet done enough to convince traders that it's always in short. It's still possible that this is a pullback in a bull trend. Now, one big bear bar, 14, would be enough for traders to conclude that we've begun a swing down. Now, if you're a bear, how are you feeling? 10, not a great entry bar. 11, 12, not great follow through. And 13, a breakout, but a big tail. And a possible bull bar, 14. So if you're a bear, you're probably thinking, maybe I should just scalp out 5 points, 10 points, and then wait to see what happens and maybe sell again. And then if 14 is a bull bar, especially a bull bar closing near its high, I would get out of shorts above 14 because you'll start to get bulls buying. Not a great high two, right? We have not had a good bull bar in 6 bars, so increases the chances of more tight trading range and limit order trading, more scalping. Some bulls bought 12 low, bought more 5 points lower, and then exited when 14 went back to their original entry price at the 12 low. Some bulls did not buy the 12 low, but they did buy 5 points lower, looking for a scalp, expecting it to go above the 12 low, which it did. This is really not the kind of environment that most traders should trade. They should wait for things to become more clear, more evidence of a trend. Great for scalpers, great for limit order traders, bad for stop order traders. Still on the short below 9. I'd get out maybe a couple points above 14 if it's a bear bar. I'd get out 1 tick above 14 if it's a bull bar. And for the bulls, we've had 6 bars without a good bull body. So it becomes a lower probability buy above 14. Probability buy above 14. Most traders should wait. This is not what they should be trading. Important bar. It's the bar after a breakout, 13. Breakout big tail, not good. Can 14 make things a lot more bearish? Can it become a very big bear bar closing on its low, closing far below 13? Probably not. But if it does, that will attract a lot more sellers. Right now, you have traders willing to sell high, 8 and 9, but not willing to sell low. Low 1, small pullback bear trend, was just above the moving average and a weak sell-off. So most bears are not going to sell below 14. It's still on the sell below 8, 9. But it might form a small wedge bottom, just like we had a wedge top, 1, 5, 8. You might get a wedge bottom, 10, 13, and 15. Because it's not yet a strong bear trend, you'll have bulls buying things that look bearish and buying more lower, betting that we'll get a reversal. I prefer, if I'm buying with limit orders and what's on a weak trend, I prefer to buy below bull bars, and we're not getting bull bars here. We have small bull body, 12, but, and 11 and 12 both have small bull bodies, but not bullish enough for me to buy. And for the bears, I would be pretty quick to get out if it starts to turn. Remember I said that on the open, we had a gap up, and the market usually ends up with some kind of a trading range open. Most days have a trading range open. Only 20% of days does the market trend up or down from the first bar. And today kind of looks like that, or like this, or like this, right? A lot of reversals. And traders wait for some kind of a breakout. Here we have a pair of bear bars closing below the moving average, so sell the closed bear trend. Here we have a double bottom, a bull bar, and then bull microchannel. So bulls will start buying. And we're not quite at that point yet where bears are willing to sell below 14. Bulls trying to, remember I said with a gap up, the bulls will try to buy a double bottom or a wedge bottom near the moving average. And if we were to reverse up here, it would be a higher low double bottom. So bulls are willing to buy, but they want to get a good buy signal bar or a big bull surprise. And bears, there's a little bit more selling than buying going on, but not a lot of bears willing to sell low in a trading range open when we're not getting a lot of strong bear bars. Bears trying to reverse strongly. So far, we're reversing, but not strongly. They want to break below the moving average and the 2 low, and then get a measure move down to yesterday's close. Sometimes a trend will not look particularly strong, but last a long time. And that's what the bears are hoping is happening here. They're hoping it's a small pullback bear trend that lasts all day. Right now, it's more likely we're going to try to get a double bottom around the moving average, double bottom 2. but one or two big bear bars, traders will conclude that we're going down to yesterday's close. Remember I said we might get an outside down day. I do not think we're going to get outside down ahead of the FOMC report because too many small sideways bars, probably too far to get down here. Parabolic wedge, 10, 13, 16, higher low double bottom 2, but too many bear bars, so I would not get long above 16. I'd get out of shorts, maybe a couple points above 16. It's still in a small pullback bear trend, but at support, and the bear trend is not very strong, so not a lot of bears willing to sell unless it becomes stronger. Just like the bulls tried to break above resistance, unable, and we went the opposite way. The bears are trying to get a strong breakout below the moving average and the low of the day, and if they are unable, then we'll go up. Trying to break to the downside. The bigger the bar is, the more likely traders will sell the close. A lot of traders will wait for consecutive bear bars below the moving average. Consecutive closes 3 bars below. Consecutive bars completely below. Reversal up, not many traders would buy it. Traders would sell again below that bear bar. You can see in this particular example, hard to hold short. Bull bar, bull bar, bull bar. So when you have a lot of hesitation, a lot of small bars, a lot of prominent tails, I think it's pretty hard to hold on to trades. New low of the day, breakout. The more 17 closes on its low and below 2, the more bears will sell the close. A lot of bears will wait for one more bar, but it's obviously becoming more bearish. We're trying to get below the breakout point here, right at it, and then down to yesterday's close and possibly a measured move down. Can you buy the close in that bear trap, double bottom? I would not. If we get a bull bar 18, I'd get out of shorts above, but it's too many bear bars for me to buy the first reversal up. I'm not particularly bearish because of the way the bear trend looks. It does not look the way bear trends typically look if they're going to last all day. It looks more like a bear leg and what will end up as a trading range. Bears, I'd get out above 17. If 18 is a bull bar, I'd get out above 18. Aggressive bulls will buy above 18, betting on the double bottom. Sometimes the second leg of a double bottom is a strong sell-off, a sell climax. Similar to this, a lot of bear bars and then a bull bar closing near its high. Some bulls will buy the first reversal up, some will wait for a second or third and then buy. So double bottom, double bottom. A lot of bear bars. Once you start to get bull bars closing near their highs, you'll get bulls buying, betting that the bear trend is failing. A lot of bear bars, but then a bull bar closing near its high. In this case, it's a higher low double bottom, a failed break below the moving average. 4 bear bars and then a big bull bar closing near its high. A couple big bear bars and then a bull bar closing near its high. So you can see lots of examples of double bottoms despite tight bear channels or a lot of bear bars. Remember on the open, I said the bulls would try to get a double bottom or a wedge bottom near the moving average. This is a double bottom, lower low double bottom 2, and a little bit of a parabolic wedge, 3 legs down, 1 pause, 2 pause, and then 3 or 4. But I would get out of shorts above a bull bar 18. Aggressive bulls can buy above 18 if it closes near its high. A higher probability, wait for a second buy. You look at 17 and you think, I got to sell the close. And then you see 18 and you say, well, that's not fair. They're taking my money. Well, that's, like I said, it's not a strong bear trend. And a lot of traders want follow through. So they don't want simply 17. They want 2 bear bars, 17 and 18. Instead, we're getting a reversal. The market often tries to reverse around bar 18. So 16 or afterwards. And this is bar 18. Can you buy above 18? It's a possible low of the day, or at least a possible low for a swing up. In general, when I have that many bear bars in a tight channel, I prefer to buy a second reversal up or after 2 or 3 bull bars. At a minimum, I think bears should get out above 17. And bulls, some bulls will buy, some will buy small, and then if it goes sideways or up, they'll buy more. But at a minimum, I get out of shorts. Now, if you're a bear, that's the absolute worst thing. You're breaking out below support, low of the day, moving average, and then you're getting a big bull bar closing near its high. So on bears, I get out of shorts. On bulls, they'll start to buy. Some bulls will buy small. Some will wait for a second buy. Now, for the bears, do they sell below 19 if it's a bear bar? It's a pretty good reversal, 18. The parabolic wedge probably will get a couple legs sideways to up. So reasonable to exit longs above 18. I did not get long above 18. I'd like to wait for a second attempt up, a high 2. And for the bears, I think it's really not a very good short below 19. The sell-off is just not all that strong. And we have a parabolic wedge and a big bull bar closing near its high. So at the moment, I think it's better either to be flat or long, and I am flat. And just like I said, bulls should wait for a high 2 or some second reversal up. I think the bears should wait for a micro double top and not sell below 1, below 19. But right now, if I had to be long or short, I'd be long. I'm flat, and I'm not going to sell below 19. Suppose the small pullback bear trend just keeps going down and down and down. Well, it's possible that I'll miss it completely, and I won't sell. Unless it gets stronger, I don't want to be selling at the low, and I certainly don't want to be selling with a limit order above a big bull bar in a weak bear trend. For the bears, a low 1, but at the moving average, a doji bar after a big bull bar and a possible double bottom. So probably buyers below 19. I would not take that sell. Bulls trying to get a high 2 buy above 20. And they'd like to get a pretty good bull bar. A limit order bulls, 19 low, will scalp out. If they don't get a pretty good bull bar, they'll get out below 19 if it's a bear bar closing near its low or below 19. I did buy below 18, not at the 18 low, a couple ticks below, and I scalped out for a couple points during 19 because it was stalling. I did not short below 19. I'm not shorting below 20. So I'm back to flat. Still more likely we'll go sideways, and most bears will want a low 2 after the reversal up 18, a pretty good bull bar, and the parabolic wedge. It's okay to be short now, stop above 19, but I think it's more likely the bulls will try to get a second reversal up. So I think it's probably better to wait to see if we get a low 2 on 22 or 23 and a micro double top before selling again. And the bulls are trying to get another bull bar closing near its high and closing above the moving average for a high 2 and possibly a swing up. Bears trying to get a breakout, a close below 18, and the bulls are trying to get a second reversal up. Good for the bears, 20 closing on its low, and 21 also possibly closing on its low. Is it sell to close? Not for me. It's just not as bearish as I want. Too many small bars, too many sideways bars, too many tails. And when that's the case, I prefer to sell pullbacks. And I did not sell below 20. So right now I'm trapped out. Consecutive bear bars closing on their lows. The second bar completely below the moving average, 21. So that's a swing sell the market, sell below 21. But the entire day has a lot of trading range price action, small bars overlap, big tails, and that lowers the probability significantly for traders selling at the low or buying at the high. Buying above 347 and selling too far down. For bulls to buy above 22, they want a bull bar closing near its high. Otherwise, I'd wait. And for bear bars, they're on the sell below 20, but only for a swing, and I would get out above a bull bar. And I'd get out maybe a couple points above 22, one tick above 21. When things are not clear, usually the trends are parts of trading ranges, and typically they do not last all day. Remember, on the way up, I said it was not strongly bullish, and on the way down, it's not strongly bearish. Possible wedge 2, 18, 22, high 2, 18, but the bulls need a bull bar closing near its high. Otherwise, they'll wait to see if we get 2 bull bars or 3 bull bars. Remember, earlier today, I talked about the 60-minute moving average, and I talked about the 60-minute chart. And I said that it's a tight bear channel, and therefore the first reversal up is probably minor, which means either a bear flag or the start of a trading range. And daily chart, 4 or 5 consecutive bear bars is extreme, climactic, probably will bounce either today or within a few days, but it's a bad buy signal bar, probably sellers above yesterday's high or not much above. Bulls keep trying, but unable to get good bull bars 11, 12, unable to get a good entry bar above 18. They should not have allowed 20 to close on its low. This is not behaving the way a swing bottom typically behaves, at least not yet. Okay, so it's a high 218, a wedge 218, but only a bull doji after 2 big bear bars closing on their lows. Okay for bears to get out either a tick above 22 or above 19, and some bulls will buy above 22. I think it's better to wait for a bull bar closing near its high. So we're still in a small pullback bear trend. The bears are hoping to get down to yesterday's close, the measure moved down, and bulls are hoping that this sell-off is a leg in a trading range and that we're at or near the bottom of the range. Whenever nothing seems quite right, you're probably in a trading range. Bulls want a bull bar closing near its high, maybe 23, and they would like 23 to close at or above the 22 high. And it's a swing trade, not a scalp. Nothing is as certain as anybody wants. We're getting all these reversals. I want to complain about Powell again. Today's an FOMC day, so the Fed becomes important. And as you know, I think Powell is the worst Fed chair that I can remember. And when I started trading back in the 80s, Volcker was the Fed chair, and he raised rates a lot and fast to stop inflation, and he was successful. Powell, from early on, when Trump was criticizing him harshly every day in the press, telling him we need zero interest rates, Powell caved and cut rates far more than he should have. And I got mad at him back then. And then a couple of years ago, he said he was not going to raise rates until 2023, and I said that was idiotic because the bond market is at a top for the next 10 or 20 years. Long-term interest rates are going up. You have to raise short-term interest rates. You can't have a huge gap between long-term and short-term rates. And then a year ago, or earlier this year, he said he was going to raise rates. Anyway, he said he wasn't going to raise rates for several years, and I said that was wrong. And obviously, he's wrong. He's raising rates now. And then at the start of the year, he said he was going to raise rates 6 times 0.25%. And I said, that's idiotic. If you know you're going to raise rates 1.5 points and you know you screwed up by not raising rates a year ago, you don't raise rates 0.25 point, you raise rates a full point. Try to get caught up. And then about a month ago, 2 months ago, he said he's not going to raise rates 0.75 point. And that was stupid because that's something the Fed could do. It's a tool the Fed had, and he's saying, I'm not going to use that tool. And now everybody believes he's going to raise rates 0.75%, even though he specifically, clearly said that's something he would not do. I don't ever remember a Fed chair making this many wrong statements. And yet the press likes the guy. I'm the only person in the country who's saying he's a horrible Fed chair and the worst Fed chair in my 35-year trading career. I don't understand why everybody else isn't critical of the guy. I think he's done a horrible job, for the reasons that I just said. But the press loves him. They think he's a wonderful guy. I just don't understand. All right, so bears are selling the close of 23, trying to prevent 24 from going above 23, because if it goes above 23, a lot of bears will start buying back shorts, and bulls will start buying to get long. We're probably going above 23, and we'll probably test around the 19 high. The bears will try to get a double top there, and the bulls will try to break strongly above the 19 high and continue back up to the open of the week. The bears are hoping that this small pullback bear trend continues all the way down to yesterday's close, a measured move, and it probably will not. However, sometimes you get small pullback bull trends, small pullback bear trends that keep forming bull bars, 18, 23, and the market keeps triggering buys above the bull bars. Yet the next bar forms a low one sell, and the bear trend continues. So because of that, the probability is not high enough for a scalp above 23. Most bulls buying above 23 are going to scalp. Why? because they're hoping for bar 72. They're hoping for a big bull trend, and they're probably not going to get it. And they'll conclude that instead of this being the start of a big bull trend, it's just going to be a bounce in a trading range day, and they'll end up scalping out. This is the end of the second hour, and the bulls are trying to get it to close above the low of the first hour. Bears, I get out of shorts here, and bulls they can buy for a swing, but they're probably going to be disappointed. And for the bears, it's a low 124, but 3 bull bars, so I would not short below 24. It's still a sell at close bear trend, but I would not sell at the low. If it were a stronger bear trend, I would be willing to sell on a stop below 23. But if we do go below 23, I think we'll probably get a third reversal up for a possible wedge 18, 23, and who knows, 26, 27. Low 124, low 125, but 3 bull bars, and different ways to look at this as a wedge, 2 and 18 and 23. So I'm not willing to sell below 24. If we get a bear bar closing near its low, maybe 25, bulls will get out below 23, below 25 or below 23. Some bulls will buy more below 23, betting on a wedge 18, 23. And for the bears, I think it'd be better for them if it goes sideways for a few more bars and we get some kind of a micro double top, either with 24 or with 19, and then a bear bar closing near its low. This is a trading range. We have the FOMC announcement in 10 minutes. Most traders should probably be flat at this point. There was a low 251 around the bear trend line 8 and 37. But the issue here is scalp or swing. Is it realistic to expect a swing in 10 minutes or 15 minutes if you sold below 51? So I did not take the sell. I wanted to sell, but it was too close to the FOMC, so I'll wait. This is a special FOMC meeting. We've had some special ones over the past year. For 3 years, or for a couple of years, the FOMC meetings were pretty meaningless because every meeting was the same. No change and no change in the statement. We still got some big trends up or down, but right now the market has the potential for making a very big move in either direction. On the daily chart, we're oversold. We've had a lot of reversals. You know, if it goes down a couple hundred points, it bounces a couple hundred points. We're down, 300 or 400 points here. So we're probably not going to go down much lower before we bounce. 5 consecutive bear bars, unlikely that will go straight up. But I do think there's probably not a lot left to the downside over the next week or so. The market's deciding, obviously, on the weekly chart and monthly chart, if it's going to come all the way back down to the pre-pandemic high. And I keep saying about a 30% chance. And if we go up, it's unlikely we're going to go up like this. We'll probably go up more, a mirror image of this. In other words, instead of straight up in a tight channel, easy to trade, you just keep betting it's going to go higher. It'll probably be a lot less clear. We probably began a trading range over here, and it kept going up, but this ended up part of the trading range. This is part of the trading range. And when we get a rally at some point in the second half of the year, that'll be a bull leg in a trading range. So I think it's probably going to be mostly a trading range for at least another year or so. We're getting trading ranges. Usually usually don't get really clear buy signals or sell signals. So traders trade small and buy when it's low, buy more lower. And then when it gets high, they sell out of longs or sell into shorts. Weekly chart, the bulls want a bull body, so they want the week to close above the open. Monthly chart, unlikely we're going to go a lot lower following a trend that looks like this. Usually the first reversal is minor. Sometimes it'll be very deep and you'll end up in a trading range, but it's probably not going to come down here, for example. It's probably not going to go down much further. Maybe, as I said, 30% chance it'll come down to the pre-pandemic high. That means 70% chance it's not going to get there. Five-minute chart, you can see anyone who sold below 51 scalped. They got their 10 points and they bought back their shorts, and that's why we're doing this. When you get these FOMC reports, I always say you have to be open for any possibility. 75% of the time, you're going to get a move in both directions. And here we were up and then down, and we continued down. And here we were down. This was actually a fairly big move down here. It doesn't look like it after you see this. There was a pretty big move down here, and then up, and then a big move down here. And the bulls did the minimum that they needed. They prevented a bear body. And so we have so that's minimum follow through, and that's a credible buy. And then you buy with bull bars closing near their highs, hoping that we go up. The strong trends, like a strong bear trend after the FOMC or a strong bull trend, happen about 20% of the time. And that means 80% of the time you get something else. So you can get a bull trend that becomes a bear trend, or you can get a bear trend that becomes a bull trend, or the market can just make a lot of reversals in a broad trading range, or this is the least common thing. Basically, nothing happens. So we're probably going to get a big move, and it could be up, it could be down, or it could be both. So it could go down and then up, or it could go up and then down. So it's better to wait for 2 bars before placing a trade to allow for the reality that 75% of the time you're going to get a sharp move in both directions. Now, what happens if he's going to raise rates 0.75%? So I know he said he's never going to raise rates 0.75%, but he said a lot of stupid things over his tenure, Chairman Powell. So it doesn't matter what he says. What matters is what he does. He said he's only going to be raising 0.25% during the 6 meetings this year. That was a stupid comment. It was clearly wrong. He said he was not going to raise rates 0.75%. That was a stupid comment and clearly wrong. He's going to raise rates 0.75% today. Now, given that everybody knows he's going to raise rates 0.75% today, shouldn't there be a consensus? Should the market go up strongly? Should it go down strongly? No, nobody knows. Nobody knows if we've already discounted it fully, and nobody knows if we discounted it too much and we're down too low and we have to go up quickly to get back to neutral. Nobody knows if we have not discounted the rate hikes in the economy sufficiently, and we have to then go quickly down. So you have to be open for anything. Better to wait for a couple strong trend bars in either direction before taking a trade. And better to wait until 10 minutes. About 10% of the time, I will trade after the first bar. But 90% of the time, I wait for 2 bars before trading. And another thing is, instead of going in assuming you're going to trade your normal size, chances are we're going to get big bars and the market's going to move quickly. You should go in assuming you're going to trade your alternate size. I talk about how you should have 2 position sizes, your normal size for most of your trading, and then a second size that is only 20% as big as your normal size. And I would go in assuming are planning to trade only your small position, 20%. And if we end up getting a strong trend, then you can add to your position as it goes up or down. For example, strong trend down, maybe sell a 20% position here, and then another one here, add to it, and after 3 or 4 times, you're just about at a normal position. Bear trend. When you get these bull bars, it makes it harder to hold short. So you don't want a bear trend that looks like that. It's better if you have a lot of bear bars like that. But the really good trends like that are unusual. But trade small, and you can obviously have a trend up, same thing. And if you don't know how to get long, first of all, trade your 20% position size, wait for at least a couple bars, and then place a stop order to buy above the high of a bar that closes near its high, and then hold on. Get out below a bear bar closing below its midpoint. For example, if you bought here, reasonable to get out below that, and then buy above that or above that again. And the opposite is true with the bears. Long ago, 20 years ago, 15 years ago, 10 years ago, the FOMC reports never came out on time. They would always come out late, sometimes a few seconds late, more often a couple minutes late, or even 10 or 15 minutes late. Now, the report has not come out yet. Right? At least I'm not looking at TV, I don't know. But this is not, it's probably not the report. So this is before the report, and we're already moving 20 points just before the report. Should you have bought about 53? No. You should never worry about missing trades. All you worry about is trades that you take. Did it make sense? Did you take a sensible trade? If you did not, exit. Are you managing the trade correctly? So I don't know if you raise rates 0.75%. The market was basically predicting 100% certainty that he was going to raise rates 0.75%, even though he said he was never going to do that. Remember, I think the market's going up, either starting today or within the next few days, because we're down too low. And we've had a lot of trading this year. So when it gets down too much, it goes up. When it goes up too much, it goes down. Okay, so this is a 30-point tall bar. You cannot be thinking about trading your normal size. I just looked at the CNBC website, and it says, in fact, he did raise rates 0.75 point, even though he said he was never going to do that. Nothing to do here. What about putting up a tick chart, like, I don't know, or a 15-second chart, every bar 15 seconds? You're gonna mess up, right? You're not going to be able to process the information quickly enough, and you're going to make bad mistakes, and you lose a lot of money. Here's a 1-minute chart. Let me see if I can put up a tick chart. 1,000 ticks, which is, it sounds like a lot, but it's really nothing. It's a really small. Normally, a tick chart with 5,000 ticks per bar looks pretty similar to a 5-minute chart. A tick chart with 1,000 ticks per bar looks pretty similar to a 2-minute chart. And I always prefer time charts because I like the predictability of when a bar is going to close. And with tick charts, sometimes a bar will close in 2 seconds, sometimes it'll close in 2 minutes. And I don't want to be watching the number of ticks, trying to figure out when it's going to close. Okay, it's still loading the tick chart over there. So when's the last time you've seen a 40-point tall bar? We've had many, but not in over a month or so. This is the point that I made, that when the FOMC report comes out, most of the time, at least 75% of the time, it's probably more like 80 or 90% of the time, you're going to get a quick move in both directions. And we went up 20 or 30 points and then down 40 points. So a big move in both directions, better to wait. Now, if I put up, here's a tick chart where every bar is 1,000 ticks, and it looks pretty easy. You got a little wedge top, and then you sell, and you got higher low, you buy. It's not easy. The stuff happens so quickly, you're not going to have enough time to make good decisions and to place orders. So you don't want to be trading something that small. 5,000 ticks, it's really no different. You know, doesn't look like much is happening, but things are moving really, really fast. You know, I'd rather just stick with the time charts. Remember, on the open, I said today could be an outside down day, but I said we probably would not go outside down before the FOMC report. I still do not think it's going to be an outside down day, but it could be. You know, this bar, look how big the bar is. You know, it's already halfway, half the size of yesterday's range. Here's yesterday's low. So we definitely could get an outside down day. Went back above the open of the week. Remember, I said the open of the week, the 60-minute moving average, and the May 20th low were all really important. And I said I thought we had to get above the open of the week today. Well, we did. That doesn't mean you could trade it, but we did achieve that objective. I said 8 did not adequately test the open of the week, and therefore the open of the week remained a magnet. And obviously 55 did adequately test the open of the week. Huge bar. Okay, can you sell at the market? No. Can you buy at the market? No. Remember, I said it's better to wait for 2 bars and see what you get. Can you buy above 56? If it looks like 53, maybe, right? But unless it's a perfect bull bar, it's not worth buying. And what about selling below 56? I'm not going to sell below 56. You know, we're getting big moves, and it still looks like a sideways day. So I would wait probably 1 more bar, 3 bars before selling. I think it's significant that we reverse down so strongly from the resistance above. What happens if we fall for a measured move based upon the height of that 1 bar? That would get us below yesterday's low, and today would be an outside down day. But as I said, I still think there's probably not much downside over the next few days, simply because we've already sold off a pretty dramatic amount. It's kind of like the opposite of this. When it goes up really strongly, that, or this, it's probably not going to keep going up. And when it goes down pretty strongly like this, it's probably not going to keep going down. We had 4 bear bars here and then reversed up strongly. We had 4 bear bars here and then reversed up for a couple of weeks. And now we have 5, maybe 6 bear bars. I talked about how you can get a lot of bear bars. And we had that stretch here at the end of 2018 where we had 10 bear bars. That's the most consecutive bear bars that I can remember. Bulls, they need a really good bull bar, closing on or near its high. And the bears, any bear bar, it would increase the chances that we're going to go lower. But if it has a pretty big tail, I think it's better to not take the trade. It looks like we tested the Globex low. On the open, remember I said that about 20% of the time the market will break out of both the top and bottom of the Globex range. And we did not break out below, but we're just above the Globex low. And on the 60-minute chart, I said at the end of the first hour that the reversal up was probably minor because this is a tight channel lasting a lot of bars. So the first reversal up was unlikely to lead to a bull trend. Sometimes it's just not, the math is just not good enough to take any trade after the FOMC. Usually you can get at least 2 or 3 reasonable setups. Here, a 30-point bar. So if you buy above 56, you have to trade really small. Remember I said, if you're taking any trade, it's better to trade a 20% position. If you normally trade one E-mini, you would buy just one or two micro E-minis. Consecutive bear bars, at least one being big and closing near its low. So it's sell the close. You can see it going down a little bit after the close of 56. But a really big tail on top, on the bottom, and there may be buyers around that 56 low. And I would not buy above 56. So right now it's sell the close, but I think most traders are better off waiting. Bar is getting a little bit smaller, but still big. What about buying above 57? It failed reversal down. Again, the bulls will want a good-looking buy signal bar. So far 57 is an inside bar. For the bulls, it's a failed reversal down. For the bears, it's a low one sell signal. Bears need it to close near its low, and even then, you trade really small. And the bulls need it to close very close to its high, and they'll trade very small. If it's unclear, if it has a fairly prominent tail, then better to do nothing and just wait more. Right now, we have a pair of bear bars, consecutive bear bars, one big and closing near its low. So it's sell the close always in short. But bears, I would get out above 56. And if 57 is a bull body, I would get out above 57. Traders are waiting to see how 57 closes. And is it worth buying? To me, that's not worth buying. We have two big dojis. That's terrible for stop entry traders. It's a low one sell for the bears, but I would not take the short. And for the bulls, it's a failed breakout below the low of the day. Bar 55, take a look at it. It made a new high of the day and a new low of the day. So bar 55 was bigger than the range of all the other bars today. A single bar. Back in the 80s, bar 55 would be the size of a bar on the monthly chart. Back then the E-mini, there was no E-mini, but the S&P was trading at 170, 200 points, and one bar that's 50 points tall, 40 points tall, that would be the size of several months. It probably would be the size of a year. I did not buy above 57, but I wanted to. And if it closed on its high, I was going to buy. So right now I'm trapped out. Tail 55, 56, 57, 58. So there are buyers around the low of the day and around this area. Can you buy above 58? If it closes near its high, you can buy, but again, I would buy really, really small. Big bear bar, and it failed. The market reversed off. FOMC, big sell-off, and it failed. The market reversed off. Big sell-off, the bear trend failed. Big sell-off, two legs down, the bear trend failed. But I like to see bull bars closing near their highs. More examples of big sell-offs that failed. And why do I have a lot of examples? Because it happens fairly often. These were all FOMC days that sold off on the report, and the market reversed up. It didn't necessarily continue up all day. For example, here it reversed up and then it reversed down. Bulls are hoping that it will begin a trend for the remainder of the day. They're hoping for that, or that, or that. So is 55 a bearish trap or a spike down that will lead to a bearish channel? The size of those tails, 55, 56, 57, 58, I think, make it unlikely that this is going to end up as a big bear trend. So that leaves us with either we go down a little bit and convert into a trading range or get a reversal, or we are reversing now. Buying above 57, as I said, if you're buying for any reason, you trade really small. The bars are very, very big. For the bears, a 50% pullback, a failure to get above the average price, but they need a good bear bar or a short. It's unlikely that they're going to get it. In the remaining seconds, is it suddenly going to close on the high or on the low and be a decent stop entry bar, or is it going to close with a big tail on the top and bottom and not entice a lot of stop order traders? So not a very good buy above, not a very good sell below. Better to wait. Low one below 58, but big bull body. Low one below 59. Bears do not want the bar to get too big, but they do want it to close near its low. If you're selling, you're looking for a swing, and since you're risking 20 points, you have to trade very small, so you would use a 20% position size. Outside down, almost outside down. This is not good behavior for traders looking for stop entries. If we do get a swing, it could be huge. The bars are big. And that's the reason why traders are willing to trade. But so far, it's a limit order market. Anything bearish, they bought. The close of 55, the low of 55. Anything bullish, they sold. The 57 high, the 58 close. Probably more buyers than sellers below 58. But most traders should wait. We have 5 sideways bars, low probability for stop entry traders. The bars are very big, so the risk is big. So you got bad risk. You need very big reward to offset risk like that and to offset probability that's only 50%. Better to wait. Easy to lose money. Sell the low of 1 and then panic. Buy, get long above 57 and panic. So outside down, but 5 bars with tails. So, and limit order trading. So not a very good sell below 59. Big bars. So increased chance we're going to have a big move. But the more sideways bars, the chance of a big move gets smaller. Bulls did not have a good buy signal bar 57, and they'll try again 60. And if 67 has a close on the high of the bar, it would be a reasonable buy. If it has a fairly conspicuous tail, then better to wait. Now, what about selling below 59 outside down? Everybody's buying here. Just look at these bars. Tails, 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 tails. 5 bars with tails. So do you really want to be selling at a price where people have been buying for 5 bars? I'd rather sell higher, or I'd rather sell lower after I see a strong breakout below. Can the bulls get a good buy signal bar, 60? There's nothing you can do that will change what the market is going to do. So better just to relax and be peaceful. And if you don't get a trade, don't get desperate and say, oh my gosh, I got to take a trade, I got to make money. It's nice to make money, but it's more important to focus on doing things that make sense. And sometimes the best decision is to wait. And right now, the best decision is to wait. If 60 closes on its high, a credible buy. If it closes on its low, and the low is exactly at the 59 low or within a couple ticks of the 59 low, it would be a credible sell below 59 or below 60. What about if 60 closes below 59 and closes on its low? No matter what 60 does, I really don't want to sell down here. We're at a price where 6 bars formed tails on the bottom. So I'm willing to sell, but I want to sell higher or lower. I want to sell higher and take a chance that we get down below. I'll have room to make a profit even if we do not. Or I want to sell lower after the market has clearly broken strongly below this support level. How do I know it's a support level? The market's not going down. So there are a lot of buyers here. Why are they buying here? I don't know. I don't care. Okay, so that's the kind of thing where you will get bears willing to take that short. It would have been better if 60 closed exactly at the 59 low. Right now it's on a short below 60. Now, what about buying at the market? Arguing the bears need to get below 59. So if you buy at the market and put a stop below 59, well, you're probably going to get stopped out. Why is that? Anytime you have a tight stop, the probability is high that you're going to get stopped out. In other words, we're probably going below the 59 low. It's okay to be short here at the market, right, on a stop, or wait to see what 61 does. It's a credible sell setup. I personally did not take it. If I were not talking, maybe I would take it. But things are moving very quickly, and it's hard to both talk and manage trades in a fast market. Bears, some of them are taking profits at the 56 low. That's about a 10-point profit. With bars big like this, a lot of people are looking for 10-point scalps. There are always limit order traders. And for example, there are limit order bulls who bought the 56 low. And there are hodl type traders, that hold on for dear life type of trader. In other words, they're not using a stop. And they'll buy more 10 points lower here, 20 points, 30 points lower, betting that we'll get back above the 56 low before the end of the day. And at the moment, I think we probably will. We've had a lot of trading range trading all day, a lot of trading range trading after the FOMC report. We're breaking below support. We'll probably get a couple legs down, but I think we'll get back above that 56 low before the end of the day. What happens if 61 and 62 are both big bear bars? Then we might not get above the 56 low. But with all the trading range trading we have here, you have to bet if people buy below something and buy more lower, they're going to make money. If they sell above something and sell more higher, they're going to make money. Had I taken that short, and if I did not take profits at 20 points, I probably would be taking profits here at 10 points. Look at what we just did. We're back above the 56 low. So the limit order bulls have bought the 56 low and 10 points lower. That ought to break even on their first buy, 56 low, and with a profit on their lower buy. Now, if the market's in a strong bear trend, it's very difficult for bulls to make money. And if bulls are making money, the market is probably not a strong bear trend. And so bulls will try to get another reversal here. You can call it a high 2, 57. You can call it a wedge, 53, 56. So what do you need to see to buy above 62? Now we've got 3 pretty good bear bars. And therefore, if you're buying above 62, you need a good bull bar. So if it's a small bull bar, don't buy. If it's a medium or a big bull bar, but it has a big tail on top, don't buy. If it looks like 53, decent sized body, close on the high, then it's a credible buy. At a minimum, bears will buy back shorts. Remember I said we might get upside down. We may go below yesterday's low. We got down to yesterday's close. The bears would like it to go upside down, and if we get one more leg down, we might go upside down. Sometimes the market will try to get upside down, but instead of going below yesterday's low, it reverses up sharply from above yesterday's low. So it's almost upside down. And it's pretty common. So above yesterday's high, and sold off, could not get below yesterday's low, reversed up. Collapsed, a sell back and test of yesterday's low, could not get below, reversed up, buy above the bull bar. Above yesterday's high, almost below yesterday's low, tremendous selling, it didn't matter, bull bar. It just was a sell back and test of yesterday's low, traders bought. Very common pattern. Break above yesterday's high, reverse down, failed to get below yesterday's low, got very close to it. Sometimes it would get all the way to yesterday's low and have an exact double bottom and still reverse up. I have lots and lots of examples. And here, a perfect test of yesterday's low, right? And reversed up. Why am I not more bearish? Because what we're seeing is not the way strong bear trends typically look. This looks like a bear leg in a trading range. It's similar to this, where I said I don't think it'll last all day. And it's similar to this, a bull leg in a trading range. Is it still a buy above 62 if it closes within a couple points of its high? It is. Okay, now it's becoming a problem, right? The bigger it gets, the fewer bulls are going to want to buy up here. But you can see the bears are buying back in a panic. They're thinking, oh my God, what have I done? When there's a lot of trading range trading, it's usually better to take quick profits. 10 points, 20 points. Now, in some other time frame, 61 was probably a good-looking buy signal bar. But I'm only looking at the 5-minute chart. 3-minute chart, pretty good bull bar. 4-minute chart, 6-minute chart, 7-minute chart, good-looking bull bar. Now, I think it's a waste of time to do that. We know everybody's buying. And markets rallied 60 points in, 6 minutes? So obviously everybody's buying. Now, can we go down below the low of the day? Nope. We've seen the low of the day. And if we've seen the low of the day, does it keep going up? It might, but we've had so much trading trading range trading both before and after the FOMC, we may simply go sideways. Huge bars, so if you're trading, you have to trade very, very small. Bulls trying to break above the 60-minute moving average and above the open of the week and above that May 20th low. And this is last week's low. They're trying to close the gap. 60-minute chart. Actually, that's not last week's low. That's just the top of the gap. Back to a 5-minute chart. Buy the closed bulls. Some bulls, well, everybody wants to buy. It's a question of how to buy. And some bulls don't want to buy here and risk here or here. So they'll try to buy a 50% retracement, which is right around that 61 high. So there'll be some limit order bulls. Right now, a 50% retracement is here, right at the 61 high. And there probably will be buyers, both, two reasons for buying the 61 high. First, a 50% retracement. And second, it's a bad buy signal bar. So some bears sold the 61 high and are selling more higher, 10, 20, 30 points higher. Although, once you see 62, I think you should not be short for any reason. Now, I said we've seen the low of the day. Why did I say that? Because 62 is such a huge reversal up from the 61 low. That means really aggressive buying, and it was unlikely that we were going to get back down again. The bears have been trying for 6 or 7 bars to drive the market down, and they're failing. They're buying back their shorts in a panic. This could end up trending for the rest of the day. Can the bulls successfully break above the 60-minute moving average and the 55 high? Bulls are hoping that we're going to do that. Big sell-off and then rally for the remainder of the day. Big sell-off, rally for the remainder of the day. I did buy. I'm going to add to my position. If you did buy and you have 20 points, I would take at least half off and then look to buy more on a pullback. The bears expanding triangle, different ways to look at it. So 1, 2, 3, 4, 5, or 1, 2, 3, 4, 5. But I think there's not much downside. I think this is a major bull surprise, and that makes a bear trend unlikely, especially with only an hour remaining to the day. So the day will probably either be a bull trend or a trading range. A trading range, we could come back to that 61 low. We could sell off for the final hour, but I think maybe 10% chance we'll get a new low of the day. When I see a bar like 62, you know the market's going up, and so I usually just buy the market. And I didn't even check to see if my fill was above or below the close of 62. But right around the close of 62, I just hit buy the market. It's still buy for any reason, but your stop is way, way down, at least below 50%. And this is 100 points in 10 minutes. So you're risking at least 50 points. So if you're buying closes here, you have to trade really, really small. We'll probably get a pullback in the next couple bars. I'm going to say something that I sometimes bring up. We're going to get a pullback, and it's going to be a buy. Should you sell and then reverse the long when you have your pullback? I typically think that, I think in general that's a bad idea. If you want to buy, it's better just to not sell and get distracted. It's better to just simply wait for the buy. Bears expanding triangle, higher high double top 55, but a major bull surprise 62, 63, probably only a minor reversal. Bulls, I'd get out maybe 10 points below a bull bar, maybe 15 points below a bull bar. I'd get out 1 tick below a bear bar, closing below its midpoint. And even if 64 closes on its low, I think it's probably not worth shorting, despite the expanding triangle. Expanding triangle means lots of reversals. But will it reverse enough so that reward justifies the risk? Better to exit longs and then look to buy a high one above 64 or 65 or 66 or 67. Huge profit for the bulls. So reasonable for bulls to sell out of longs. Now, there were some limit order bears that sold 55 high, 10 points higher, 20 points higher. They're trying to get it below that 55 high so they can get out break even on their first sell. I would not take that sell. I would only be buying as it's going above 55. I'm not sure if that will dip below 55 to allow those bears out with a profit. We probably will with all the reversals that we had, but I think it's better to look to buy a high one over the next few bars than to sell below 64. Even if you get a big bear bar after that kind of a rally, there probably are more buyers than sellers below. good to wait for a high one buy, a bull bar closing near its high. 3 bear bars, still better to buy than to sell. Wait for a bull bar closing near its high. Bear bar, reversal down 3 bars, better to only buy. Bear bar, don't sell, only buy. 3 bear bars. You don't have to buy that bull bar, but once you've had a second one or another high one or a bull bar, at some point you look to buy it again. Bears tried to get a second reversal down, low 1, low 2, but pretty good bull surprise. Better to focus on buying until things are clearly bearish. Really good rally, 4 bull bars. 3 bear bars, I'd still rather buy either above that or above that lower high or above that. So I am not going to go short below 64. I'm looking to buy a high one above the bull bar. There'll be a lot of sellers below 64. Probably not. Can we correct 50%? Probably not. Bulls trying to get a high one above 65 or above 66 or 67. And bears, at a minimum, are trying to get 1 tick below 55 high. So the limit order bears have sold that high and sold more higher, or the bears have simply started selling 10 points higher and make money. Okay, we fell below. That means it's less bullish than it could be. %50 pullback, right around 59 high. Probably buyers around 50%. What happens if it just keeps going down, down, down? When will I sell? I'm probably not going to sell. I'm looking to buy. Big enough bull surprise. This is still probably a minor reversal. Remember I showed that one example of how the market had very big moves up and down. This kind of a day, it's possible that we're doing that. That's not what I want. This is what I want, where you have this kind of a day. Big, big breakout, big reversal down. So big down, big up, big down. Probably by the close. Testing yesterday's high. There was resistance, 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 resistance right here. Is it going to be support? 60-minute moving average, possible resistance. So we broke above the 60-minute moving average and we're stalling. And the bears get a third bear bar. That will make traders see this as more bearish. And you'll get more bears starting to sell, and you'll have fewer bulls looking to buy. Starting to sell, and you'll have fewer bulls looking to buy. Can you buy above 66 if it closes on its high? You can, but the size of the 2 bear bars, I think, increases the chances that we're going to have to go sideways for another 2 or 3 bars. Important bar. If you get a third bear bar, especially closing near its low, then we'll probably go lower, possibly all the way to the 61 high. If we get a bull bar closing near its high, you'll get bulls buying, but I think it's a problem. 2 big bear bars, 64, 65, that's going to reduce the number of bulls willing to buy above 66. I did buy with a limit order somewhere below 37.90. I wanted to buy at least 10 or 15 points down, and I just got out with a few ticks profit. Disappointed that the bulls were unable to get a better looking bar, 65. Are the bulls going to buy the 50% pullback to the moving average? A certain number of them will. And I did not. and I'm thinking I made a mistake by not. I was typing over there on the Al's notes. I should have taken that buy, try to get 10 points out of it. That was kind of an easy bet. Pull back to the moving average, 50% down. Very big bars. So if we get a decent bull bar of 66 and you buy it, you're risking a lot. You're risking 25 points. You have to trade small. And it's better just to have two position sizes, your normal size and a small size. So if your normal size is 5 micro E-minis, your small size is 1. All right, so it's better just to have two sizes. I'm not buying above 66, even though it's a 50% pullback to the moving average. It looks like we might get stuck between the two moving averages, the 60-minute and the 5-minute. I'm not willing to sell the close. We're still holding above the moving average, a 50% pullback. And I don't want to buy above 66, probably sellers above after 3 decent-sized bear bars. If you ignore the points and ignore how big the bars are, it makes sense to think about selling 66 high and or selling 10 points higher, and then scalping out with 10 points. Can you sell on a stock below 66 or 67? I would not. I think we're probably not going to go down much, and we just get stuck here. Big up, big down, big confusion often leads to a trading range. Limit order bears should make their 10 points above selling above 66. Actually, I just checked. They've already made their 10 points. There's nothing you can do to change what the market is doing. And this is more limit order trading, even though the bars are very big. And most traders should not trade with limit orders because they'll panic out and lose money. Now, buying above 61, even though it's a high 2 and expanding triangle, is 3 bear bars. So there are some bears who sold the 61 high, 10 points higher, 20 points, 30, 40, 50 points higher. And then guess what those bears would do? What do you think they'll do? Okay, take a look at this. So if you sell with a limit order, 61 high, and you scale in higher, or if you sell the 61 high and just wait for a bear bar closing near its low, 64, and sell more below 64, it has to get below your average price for you to avoid a loss. And look at the 66 low and 65 low. So you sell here, you sell with a stop below there. That pink line is your average price. It fell below the average price. So bears, smart limit order bears who sold 61 and scaled and traded properly, sell 61, wait for a bear bar 64, and sell more below 64. They were able to avoid a loss. They didn't want the market to go up that high. They wanted to just go up a little bit and then down and get a quick profit. But there are some bears who held through all of this, looking at 61, a reasonable limit order sell, and they know there's an 80% chance they'll make money if they wait for a bear bar, 64, bear bar closing near its low, and sell more. 80% chance it'll get to the midpoint of their 2 sells, and that will allow them to get out break even. I should have been thinking more about that. Up there at 64, I possibly would have shorted it, thinking that we had to come down to that pink line. That was kind of a mistake. And part of that is distraction. When I'm talking in the room and typing in else notes, it's hard for me to catch every little thing that I would catch if I'm not also talking and not also typing. Low 167, but a bull bar. probably buyers below. Bulls trying to get a high 2, high 166, the 3 big bear bars. They'd like to get a high 2 with a pretty good bull body, maybe 68, maybe 69. The bear is a lower high, a low 1, and what they hope is a bear trend, 64, but probably buyers not too far below. And for the bulls, it's starting to form a tight trading range, and we're at 2 moving averages near one another. So that will reduce the number of stop order bulls buying above 68, and it will reduce the number of stop order bears selling below 68. More likely buyers below. I think we're always in long, and I think we're going higher either today or tomorrow. And therefore, I'm not willing to sell above a bull bar of 68 if it's a bull bar. But it's not a great stop order buy. We had 4 sideways bars of tight trading range. And tight trading ranges are low probability stop order setups. And they always are forcing you to buy at the top or sell at the bottom, which is a low probability bet. So if 68 closes on its high, or very close to its high, if you buy, you got to be trading for a swing, a test of the 63 high. I think we're going to get to the 63 high. I don't know if we'll get there from 68, or if we'll get there from 68. Pretty good bar. If you want to take a chance, you can take a chance. But your stop is big. Target 63 close. You have by the close bulls disappointed 64. If they did not get out below 64, they're trying to get out around break even, so they're hoping to get back up to that 63 close. But resistance, every time we've tried to sell off today, we reversed up. Every time we've tried to rally today, we've reversed down. 62, 63, dramatic, and they might influence the market for several days. So it's possible they are a spike. They're forming a spike up, and that we could get a channel up over the next few days and go higher. Remember, I said I thought we would bounce a couple hundred points or so, possibly more. And again, I don't know if the bounce will start today or if we have to go sideways and form a micro double bottom with yesterday's low. The bears, the lower high, a low 1 in their bear trend, 66, but only a swing trade. And 68 for the bulls, it's a high 2 buy, but big sell-off, 66, so only a swing trade. They bought at the moving average a few minutes ago. They'll probably buy there again. Probably limit order buyers, 68 low, moving average. Limit order scalping. Decent bull bar, so reasonable for bulls to buy, but only if you're buying for a swing. You're buying in the middle of a tight trading range. And we have 2 moving averages, and they're near one another. So reduces the chances we'll go far up or down. Because of the trading range trading, I think bulls will scalp apart at 10 points. I did take the buy, and I just scalped out part. Is it buy the close? Well, I think we're always in long, but trading range for about 10 bars. So the math is not as good as it could be. I would get out around the 70 high. If it goes straight down, I'd get out below bear bar closing below its midpoint. It is buy the close, but your stop is 20 points down, so you have to trade very, very small. I still have a part of my position, but I'm going to be quick to get out if this does not become a pretty good bull bar. Still buy the close. The bears want double top 64. I would get out below 72, even though it's a bull bar. We're getting late in the day. I would not want to give anything back. It's still buy for any reason. I would get out below the prior bar, even though it's a bull bar. Late in the day, don't want to give anything back. I just went flat. I have a good profit. Late in the day, don't want to give anything back. What about shorting below 73, a wedge, 55, 64? I'm not willing to do it. That's a strong rally. Past 4 bars reduces the chances of much of a pullback. It's still buy the close by the market. But I'm not going to take any more trades today. That was my last buy. Other profit takers coming in above 64, just like profit takers sold above 55. Too much risk, not enough time for the reward. So I'm not selling below 74. 74 is mostly bulls like me taking profits going into the end of the day, just in case there's a lot of profit taking. You want to be at the start of it, not at the end of it. I refer to this as a wedge, 55, 64, but 62, 63 is strong enough so that it would likely start the count over again. So I think we're going to get one more new high, but it's possible that it comes tomorrow, not today. This is the second big reversal down after this and this. That will discourage bulls from being willing to buy again. So I think it's probably worth waiting for tomorrow. Back at the 60-minute moving average. Testing the open of the week. The bears do not want a bull bar on the weekly chart, so they want the week to close below the open. Both moving averages are flat and near one another. And that's a sign that the market is fairly neutral on both the 5-minute and 60-minute charts. And we're getting big up, big down, big down, big up, big up, big down. We're probably going to be mostly sideways for the end of the rest of the day. I'm not going to take any more trades. I'm not doing anything here. I said that I get out of longs right after the close of 73. I don't like to reverse, so I did not sell below 74. Also, I'm not eager to sell when we have 4 bull bars closing near their highs, 73. Especially when we have a major bull surprise, 62, 63. So I let it go. I did not do anything. I'm not taking any more trades. I always think of the FOMC days as 2 different days, before and after the report. And let me focus on what took place before the report. On the open, we had a pair of doji bars, and that means the market is neutral. And even a single doji bar, bar 1, increases the chances we're going to have a lot of trading range trading. And then when you have 2 doji bars, it further increases the chances. And pretty much for the first, well, I'm looking at the chart, until bar 20, every bar had at least one prominent tail. And again, trading range trading. A tail means the market went one way, and then it went the other way. So for the bulls, the gap up is a bull trend. 2 is a high 1 buy, but 2 dojis in the bear body, I would not buy that. And 3 is a bull bar, closing near its high, but not quite at its high. I said it was probably okay to buy the close. And then 4, we had consecutive bull bars with at least one big in closing near its high. I said, yeah, it's by the close, but it's not all that strong. And I talked early a few times about possible wedge top or a double top. The bears got outside down 5, a low 2, 1, and possible high of the day. And if you're long, I'd get out of longs below 5, but I wouldn't buy. And then 6, an inside bar after an outside bar, IOI, but a big tail and possibly a third leg up. We went up on 1, down on 1, and then up to 5 and down. So a possible wedge and possibly sellers above 6. The bears got a wedge reversal 8, 3 legs up, 1, 5, 8, but it's a tight channel, only one big bear bar, and 8 is a doji, so it's probably a minor reversal. 9, a bear bar closing on its low. If you're looking to short, 9 makes more sense. But because of all the tails and all the reversals, it's probably not going to be a big bear trend. 10, a bear bar, but big tail below, big tail above. So a weak entry bar, and then more weak follow through 11 and 12. For the bears, it's still on the short below 9, you could maybe below 8. And then a low 112 of a doji bar, not good. And 14, I said that if 14 closed near its low, it would be a relatively high probability sell. We got down to the moving average. The bulls tried to reverse at 18. Possible parabolic wedge, 11, 13, 16. But I said we have 5 consecutive bear bars and no good bull bar, or 10 bars. So it's probably a minor reversal, and I would not buy above 18. For the bears, a low 1, 19. I thought there'd be buyers below and below 18. If we went below 18, then we'd have a wedge with 2 and 18. If we held above 18 low, then we'd have a double bottom, 18 and who knows, 22, 23. For the bears, they have a better low 1, 20, closing on its low. But I think there'll be buyers not far below 18. Pair of good bear bars, 20, 21, and traders bought the close and bought the low. We got an outside up bar 23, and I said I thought that was a reasonable buy. It's a high 2, 18, a lower low double bottom 2, a wedge with 2 and 18, parabolic wedge with pick your bars 13, 18, and it's closing near its high. So I thought it was a good candidate for a swing up, at least a 50% retracement. And that's what we got. 24, not a good entry bar. 25, not a good follow through, but bull micro channel. 28, a low 1. For the bears, it's a bear flag. We got a bear trend, a bear flag, a double top bear flag, micro double top, but a 6-bar bull micro channel. So probably buyers below 28. High 129, good. 30 closing near its high, still buy the close. 31, a low 228, but 3 bull bars, small pullback bull trend, probably buyers below and at the moving average. And 32, it's a high 1, but it's a third leg up. 26, 31, and it looks like a trading range day. So there might be sellers above 32 and above 31. Makes me less willing to sell above, to buy above 33, and I did not. 36, a high 1, but a bear bar. Now the possible wedge, 27, 31, and it's just too high up in a day that looks like a trading range day. The initial rally had a lot of overlap, a lot of tails. The sell-off, it lacked consecutive big bear bars. All the bars had tails. This rally lacks consecutive big bull bars. All the bars have tails. So it looks like we're in a trading range, and therefore I do not want to be buying high above 36, especially above the bear bar. Might be more sellers than buyers above. Outside down 37 in a wedge in a lower high major trend reversal. You can either sell below 37 or 38. 38 is a third consecutive bear bar. It's closing near its low, so we'll probably go lower. But I think there'll be buyers around the low of the day. If we get a higher low, then it'll be a double bottom. If we get a lower low, it'll be a wedge. The bear's got a big breakout, 41. Bear surprise, outside down, probably going lower. And then another big bear bar, 42. But if it's a trading range day, a lot of times the day looks most bearish right before reversing up, 17, 20, 21. So I would not sell the close of 42. 43, not a great looking buy. You can call it parabolic wedge, maybe 36, 39. But I'd rather look at it, I'd rather call it a wedge with 2 and 23. You can either buy above 43, use a wide stop, scale in lower, buy above 43, put a stop below 42, and if it reverses up again in a couple of hours, buy again. Or you can wait for a second buy above 46 or 47. The bears, low to 51, but probably a minor reversal. We had an 8-bar bull microchannel on 47. Probably, I suspect, we're in a triangle. We have a lower high 37, lower high 49, and this is a lower low, but I would still call it a triangle. If you want, you can call it a wedge. And then we're getting very close to the FOMC report, and I would not sell below 51. I would not buy above 53. 53, 54, pretty dramatic rally. So whatever, 30-point rally right before the FOMC report, but I would not trade this late. 55 is the FOMC report. 1 bar, it made a new high of the day and a new low of the day. So 1 bar, a 50-point bar. It's bearish. It's a very big bear surprise. Probably we'll get at least a small second leg down, but that does not mean a bear trend. If the next bar is a big bull bar, I would buy above it. And what it is a bear doji. So now we have consecutive bear bars, 1 big closing near its low. Theoretically, it's sell to close. It's enough of a bear surprise. We fell 60 points in 10 minutes. We're probably going to get a second leg down. So there probably are sellers above 56. 57, a micro double bottom, and a bull doji. But it looks like limit order trading. Tail on the top of 56, sellers above, tail below, buyers below. 3 bars with tails. They're buying at this price, 37.50 area. But it's not a good buy, 57, so they're probably sellers above. 54, not a good sell. So there will be some theoretically limit order bulls above the 54 low and bought more lower, 10, 20, 30 points lower. And you can see 58 went above the 54 low, and the bulls made money. So that's good for the bulls. However, we still might get a second leg down after 54, and then the bear follows through 55. This is not good stop entry trading. Big outside down, 59, but 5 bars all with exceptionally big tails and big ranges, and limit order traders are making money. So, yeah, I think we'll get a second leg sideways to down. It's possible 59 is all that the bears get, but I suspect we'll go lower. And then 60, I said, if 60 closed near its low and near the 59 low, it would be a reasonable low 1 sell. But with all these tails, I'm not confident that this is going to turn into a big bear trend. We had another bear surprise bar, 61. And for the bulls, it's a high 2, 57. You can look at it as an expanding triangle, 23, 37, 42, 55, and now 61. But 3 bear bars, so I would not buy above 61. For the bulls, it's a wedge. or an expanding triangle, wedge 4256. It's a high 257. We have a double bottom 5661. The neckline is 59. So you could either buy above a bull bar 62, or you could buy on a stop above the neckline 61, or you could buy the close of 62, which turned out to be a very big bull bar. An exceptionally big bull bar, 50 points tall. Probably the bears are giving up. They've been buying on all of these bars, tails, and they got a second leg down, 61, and could not get very far. So it looks like this is probably going to remain the low of the day, and this is by the close. Now, if you buy the close of 62, stop is below 61, you have to trade very, very small. If you want, you could wait for one more bull bar, and it's an even bigger bull bar, 63. It's still by the close, but if I'm a bull, and I am, I'm going to be taking at least partial profits up here, because I know nobody is going to want to buy the 63 close, as bullish as it is. Nobody's going to want to buy that and put a stop below 61. So we should get a pullback starting in the next bar or two. So I'm going to get out of longs and wait to buy a pullback. Bears, a good looking bear bar 64, but it might be sideways instead of down. Reasonable to get out of longs below 64, but 64 did not go below 55, and therefore there may be bulls buying the 64 close and low, trying to prevent it from going above 65. Scale and bear sold 65, 55. Scale and bear sold 55 high, 10 points higher, 20 points higher. They needed to go below the 55 high. I'm getting out of longs early in 64. I don't like to reverse, and I think there are going to be buyers around 50% down, which is around the moving average, around the breakout point, the neckline of the double bottom, 59. And it's also around 62 when that's where the market clearly became bullish. So there are a lot of reasons for it to test down there. It might test all the way to the 61 high, but I don't think it'll get there. In any case, you can either sell below 64 and then look to buy around the moving average, 50% pullback, or you can ignore the sell and look for the buy around a 50% pullback, which is what I typically do. When I'm very confident that there's going to be a second leg up, I usually do not take the pullback to the second leg up, because very often it will just go sideways and it's a distraction. I'm managing a short and I want to get long. And that's a distraction. I'd rather miss the short and focus on getting long. 3 consecutive bear bars. For the bulls, it's a high one. It's a 50% pullback. It's a test of the moving average. It's a test of the 59 high, the neckline of the double bottom, 56.61. All good reasons for limit order bulls to buy. But a high 166, 3 big bear bodies. They're probably sellers above 66. So I'm not going to buy on a stop above 66, although I did buy around a 50% pullback for a 10-point scalp. 68, we have 2 bull bars. You can buy above 68. It's a high 2, 66, but it's also possibly a tight trading range. So if you buy above 68, it's probably good to use a very wide stop at a minimum below 66. For the bears, it's a low one. They're hoping 64, 65, 66 is the start of a bear trend, and this is a low one pullback. But I think we're always in long, and I think we're going to get up to the 63 close. Might not. You got 63 by the close bulls, disappointed 64. That tail on the top of 65 got near the 63 close. So a lot of the bulls were so eager to get out that they placed a limit order to get out, 3, 4, 5 points below the 63 close. So it's possible that 65 was the parachute for the bulls, that their chance to get out with a small loss. So 68 below one, I think there'll be buyers below, but I also think sellers above 66. Outside down 69, but probably buyers below 68, probably buyers below 66, and buyers below 69. And then 70, a bull bar closing near its high, another attempt up, a third one, and we had a decent bull bar 68, a decent bull bar 70. We're at the moving average from like the double bottom, a higher low of 66. I think it's a reasonable buy. I said we should get a second leg down after 66, but I also said we should get a second leg up after 63. We've had the second leg down, 69. We have not had the second leg up, and this is a good candidate. Instead of buying at the top of the tight trading range, 68, you're buying more in the middle. So I think that's a good buy. Bull surprise 71 should go higher. Another bull surprise 72 and 73, another very good bull bar. But a lot of trading range trading today and a big sell-off 64 and then a second leg 69 and expanding triangle, tried to reverse down here. Every time we got a new low, they bought it and made money. Every time we got a new high, they sold it and made money. So I think we might not go all that much higher. So I think it's reasonable to get out of longs below any bar, 73, or just at the market, 73 at the close. Big outside down 74. You can call it a wedge, 55, 64. You can call it an expanding triangle, a second sell. But I think we're probably not going down all that much. Pair of big bear bars might go lower, but I'm not going to trade it. Too much risk that will just go sideways. Look at the two moving averages. They're side by side and flat. And that's a sign of a sideways market. And it increases the chances that we'll go sideways more. We closed just below the open of the week. So on the weekly chart, we have, let me do it, use this. On the weekly chart, the bulls are trying to get another reversal. Tried here, breakout, tried here. So for the bulls, it's a high 4 buy setup. And this week is a reversal bar so far, a close above the midpoint, but it's a bear bar. So far, we have a bear body. The bulls would like the week to close on its high, and they'd like the body on the week to be pretty big to undo some of the bearishness of last week. In daily chart, the bulls tried to do something special and failed. What did they try to do? We had a bear bar yesterday. Today opened around the open of yesterday. And at one point, today was a big bull bar. So if you have a big bear bar and the next day it opens around the close, around the open of the bear bar and becomes a big bull bar, theoretically you have a lot of trapped bears and it increases the chances of a rally. Here's the opposite. Big bull bar. Next day opens around the open of the bull bar, so there's not much overlap, and then a big bear bar. You often get follow through selling. Sometimes it will lead to a major reversal. I have to go back a while to find an example. Yeah, here, a big bear bar, and then the next day opened at or above the open of the bear bar. So all the bears who sold are trapped, and they bought back in a panic. So sometimes it leads to a reversal. It's not a great pattern. It's not a really high probability pattern, but it's something that I pay attention to. Daily chart, it's a low one, but a bull bar and a 3-bar tight trading range, and we're way oversold. It's like buying a high 1 above a bear bar up here. So this is the opposite of that. There probably are buyers below, just like there were sellers above up there. This is the opposite of that. There probably are buyers below, just like there were sellers above up there. Have I complained enough about Powell being an idiot? I don't think I can complain enough about him being an idiot, but I've said enough today. Question, you mentioned buying the 62 close. Can you comment on why it's a good buy, especially if it's at the top of a trading range? Or do you consider the double bottom 56.61 outweighing the buying at the top of the trading range? Yeah, I thought as big as 55 was, I thought I was expecting a second leg down, but with all the tails, I was also expecting a reversal. And not only did we get a reversal of 62, we got the biggest body of the day, and that's after a really big bear body 55. So I was very confident that the bears made 2 strong attempts to go down and they're failing, and now we're going the other way. So I was very confident that we were going to go higher, high probability. The problem is stop. You know, if you buy 62 close, where does you stop? At a minimum, probably 5 points below the midpoint, maybe 5 points below the 61 high, ideally below the 61 low. So yes, I thought buying either on the stop above 59 or the close of 62 or above 62 was a very high probability to make at least 20 points. Question, how important are the gaps between bars for giving information about price action? You know, you hear me talk all the time about gaps, about we're breaking above the moving average, should we close above 17? We have a gap between the close of 17 and the moving average. That's a big bear bar closing near its low. It's a breakout. It's a close below 2. It's a close below 16. So it's a gap in many ways, but the bears need follow through. So I'm always looking for gaps, and I'm always paying attention to closes, especially around the moving average or support or resistance. The more signs of strength, let's talk about bulls. The more signs of strength, the more likely the market's going to go up. And if you get a lot of bull gaps, but that's a sign of strength, and it increases the chances that the market will go higher. So I don't place trades based alone on gaps, but I pay attention to them. A question about crude oil. How important are the gaps between the bars for giving information about price action in crude oil? The chart looks cleaner if we use gapless bars, but I'm worried about missing important information. He's probably talking about the 5-minute chart. Crude oil is a huge volume market, and it's a really good market for day trading. So you can trade it. I think it's better than the euro. It's probably the second, outside of the stock index futures. If you're trading a futures market or a commodity market, crude oil, I think, is the second best one for day trading. Lots of good, reliable signals. But anyway, question: how important are the gaps? The chart looks cleaner if I use gapless bars, but I'm worried about missing much information. If by gapless bars, I don't know if you're talking about range charts or one of those other types of charts. To me, I look at this 5-minute chart, and I would trade it exactly like I would the E-mini. And there are no gaps between the highs and lows of bars. Right? There are some body gaps and gaps closing above or below the high or low of the prior bar. But I would not, if I haven't day traded crude oil in a while. I still am willing to day trade it, but when I do, this is exactly what I use. I just look at a regular 5-minute chart and just trade it exactly as I've traded the E-mini. So I would not worry about using gapless bars. I would simply trade what's in front of me. Okay, question: how did you manage buying above 23? I thought we might get a double top 19, but we were in a bull microchannel. I think it lasted 7 or 8 bars. So the bars were small. I'm always going to take some off, like scalp out. If it doesn't race up, I'm going to scalp out part for 5 points. And if it keeps going up, I'm probably going to scalp out at 10 points, unless we get a surprisingly strong upside breakout. If it's rallying like it did, and it looks like a trading range, I'm going to exit on a reversal down, below 37, or I'm going to exit with 5 points and 10 points, and that's how I traded it. So where do we go from here? I think the bulls will need the market to go sideways more before they can get much of a rally. And the market's still deciding how far down we go. We have, on the daily chart, we have a higher high double top, measured move down just below. At the moment, it still looks like we're going lower. This is so oversold, we may rally for a week or two, but I think we'll probably go a little bit lower. But I do not think we're going a lot lower. For your retirement accounts, can you start to buy Yeah, anytime the market's down 20%, and your time horizon is 10 years, 20 years, I think it makes sense to buy. If it goes down more, you can buy more. If you buy 20% down, do not buy more 23% down. If you buy 20% down, the next time you're looking to buy it is maybe 30% down. All right. Hope everybody has a good night. The week is deciding. Will the week be a bull bar? Will it be a big bull bar? Will it be a big bull bar closing near its high? Will it close above last week's low? The more of that we have, the more likely we're going to rally for a week or two. Remember, I said that time window is around June 26th to July 5th. I don't trade calendar trades because the probabilities are never as good. They sound good. Sometimes I'll say that 90% of the time it goes up in a certain window. But there's so many factors involved that I think it's just one of those little things that I consider. I don't consider it a major thing. Now, if we sell off strongly down to June 25th and get a really good bull bar June 26th, I'm going to be more inclined to look to buy for a bounce lasting about a week. All right. Hope everybody has a good night.